Well, good morning, everyone, and good evening to those of you and those of us who are dialing in from Europe. My name is Jeff Abbott. I'm one of the co-founders of Global Scaling Academy, and we're delighted to have you with us tonight for this first episode of our monthly webinar and podcast series called the Blitzscaling Breakout. I'm sure that a number of people will continue to join us in the minutes ahead, but now that Scott and Chris, our featured guests, are with us tonight, we might as well go ahead and get started with introductions. So first, Global Scaling Academy is a virtual community where scaling founders, corporate innovators, and venture investors come together to collaborate to scale their ventures. It's an online community, and inside the community, the common language that we speak is blitzscaling. And so tonight, our focus, and indeed the focus of all of the upcoming events each month of the Blitzscaling Breakout, is going to be how to apply the blitzscaling framework to venture investing. Specifically, what do you look for as an investor in a company that could make it blitzscalable? And tonight, my two special guests are Chris Ye, the co-author of Blitzscaling with Reid, Hoffman, and Scott Johnson, the managing partner of Blitzscaling Ventures, a venture fund that is created to look for, globally, companies with the capability of blitzscaling. And so this is our first episode, and each month, Scott and Chris will continue to join me as co-hosts of this event, and we'll be bringing on guests from around the world, from different regions, to talk about the companies that are scaling, to talk about what it takes to scale a company from the Baltic region, or from South America or China, and apply the blitzscaling framework in a consistent way to look at both the common challenges and opportunities that they face and the specific differences in each region of the world. Tonight is the foundational episode for the series to come, because tonight, Scott and Chris and I are going to discuss the basic application of the blitzscaling framework to venture investing, and that is going to inform each one of the upcoming episodes in the months ahead. So with no further ado, let me introduce Chris and Scott. Chris and Scott, would you like to take a moment to introduce yourselves and say hello?
Certainly. Thank you so much, Jeff. This is Chris Ye. I am the co-author of Blitzscaling, as well as the Alliance, and a longtime Silicon Valley guy. I'm also one of the founders of Blitzscaling Ventures, along with Scott and Jeff. And I'm delighted to be here with you guys today to share some of my thoughts about blitzscaling and specifically how we can apply those principles to investing.
Hi, I'm Scott Johnson, and as Jeff mentioned, we're all working together on a fund called Blitzscaling Ventures, and my background is as an investor. So I've been investing for a couple decades now in early and growth stage companies across the United States, and at pretty much every stage. And this fund that we're working on now is a growth stage fund. And what we do is we find deals that have gotten capital from some of the premier venture funds in the world and just look at the ones that are blitz scalable. And we're going to talk about what that means today. We're going to hear it right from the horse's mouth. Chris is going to tell us what it means to actually be blitz scalable. And that's not every company, and it's also a highly nuanced question. And so we're going to get into some of that with a few examples today. I think it's going to be a great session. And
awesome.
So thanks for the introduction, John.
Thanks a lot, Scott and Chris. So Chris, why don't we dive right in? And I guess the first question is, what is it about blitzscaling that can cause a blitzscaling company to become so valuable?
Well, if you think about it, the core idea behind blitzscaling is pretty simple. If you're in a winner-take-most market, you can achieve leadership in that market that is lasting and extremely profitable if you're the first to achieve critical scale. And the way you do that is by blitzscaling, which is to focus on speed ahead of efficiency, even in the face of uncertainty. Now, it really boils down to the market dynamics. Remember what I said, a winner-take-most market. So when you have a winner-take-most market, what it means is that as you achieve critical scale, some sort of competitive advantages kick in. Oftentimes, this is due to network effects, because network effects are a great way to improve the value of a product to the end user so that it's almost impossible for someone to choose something else. You can think of a product like Facebook, for example. It's very hard to start a social network that directly competes with Facebook because everybody's already on Facebook. So much of the value is not in the product itself, but in the other people who are using it. And so if you have a winner take most market, the thing that happens is that you achieve a dominant and enduring market leadership position. So if you think about something like Facebook, for example, it's almost impossible for someone to catch up. And that means that you have tremendous power in terms of being able to extract value. And if we look at the companies that have these really strong winner take most characteristics, a Facebook, for example, a Google, an Amazon, if we look over even old school companies like eBay or Craigslist, you have
Or
the
the New York
ability to
Stock
essentially
Exchange,
print.
if you want to get even older, the New York Stock Exchange is a good example.
Exactly. You have the ability to print money. So that's what makes them so valuable. You achieve an enduring position of market leadership that lets you print money. And guess what? Investors like businesses that print money.
Scott, so I remember the first time that you saw Chris present blitzscaling, and
Yeah.
your first thought was you could form a fund around this, you could invest around this. And so how has your thinking evolved in the past few years? When you look at a company, how can you tell if it's blitzscalable? What goes into your determination of that?
Well, so yeah, I'd like to get into the history a little bit, which is that I did see Chris present the ideas of the book before the book was out. And immediately I wanted to stand up and cheer because this was about, I don't know, 17 years into my career, right? And I've been looking for a framework. I've been looking for a way to systematize the likely picking and grooming of really high potential. The fact is there are about 20 deals a year that really matter, that really drive the bulk of the adventure returns. And so how can you systematically identify the companies that are likely to be one of those 20? And all my investing, I've done successful investing, but it didn't feel programmatic. It felt instinctive and gut. And when I saw Chris present the ideas of blitzscaling, I said, okay, here's a framework that describes the best investments I've made actually fit exactly into this framework. And so this is what I've been looking for. And I want to build something that's great, that uses these ideas. And it's not surprising it was so great, right? Essentially, the book Blitzscaling is taking all of the amazing investment decision making out of Reid's brain and putting it in a book. And so, and it's happens to be true that Reid has been involved in more than $1 trillion in market cap in his brief investment career, which we added up the other day. And Facebook's about 3/4 of that, but then you've still got 250 billion beyond Facebook. I don't even think everybody knows that Reid was the first investor in Facebook, along with two of his friends. So it just excited me a lot to see this structured and in a way that you could actually apply to investing. And it leads me to a question for Chris, though, which is, who was the audience of the book? Who was the intended audience of the book? When you sat down to write it, who were you writing it for?
Well, that's an interesting question because there are multiple audiences we had in mind, and that we had to serve all those different audiences in different ways. So the first and foremost audience that Reid and I always had in our mind as we were writing the book are the entrepreneurs themselves, the ones who are trying to do this, because this is really hard to do. And there really hadn't been a lot written about scaling. And so we really wanted to make sure that people around the world could benefit from the lessons, so that even if they weren't able to drive up and down Sand Hill Road or come and see Reid and I in person, that they would have a chance to learn these lessons. Now, the interesting thing is that wasn't the only audience for the book, because when you put out a book, you also have to think about it not just as a work of art or a work of thought leadership, but as a work of business. And so one of the things we wanted to do is we wanted to make sure that the book reached a broad audience as well. And that was absolutely something that was on the minds of our publisher, Penguin Random House, who wanted to make sure the book would sell broadly. So instead of pitching it solely as a handbook for entrepreneurs who were building a company that they hope would be worth $100 billion, which is a more limited market, it was pitched as a way of understanding the phenomenon that was driving the rise of Silicon Valley and China and other places like that. And so our goal was to write for an audience, specifically a business audience, that was interested in understanding this phenomenon. And that included not just the entrepreneurs, but the investors who are looking for deals like this, the employees of these blitzscaling companies who needed to understand how their company was likely to evolve as it grew, and also the corporate side. So big companies looking at this phenomenon, worrying about being disrupted by the latest blitzscaler, understanding how they could respond. So we actually have entire chapters, for example, that look at China as the land of blitzscaling, that look at blitzscaling in other regions of the globe, that look at blitzscaling for large organizations. And that's part of what we also do with the Global Scaling Academy, try to take some of those elements and bring them to life for those audiences.
So it leads me to a follow-on question, which is, so investors are clearly one of the audiences, right?
Mhm.
And so, which parts of the book do you think are most important to investors? And can you just talk a little bit about how we're using the book at Blitzscaling Ventures, both to sort of narrow down our choices and then, really, really zero in on the ones we think have the highest potential?
So I'll let you in on one of the dirty little secrets of venture capital, which is that most venture capitalists earn their money by getting access to the deal and by selecting the deal rather than helping build the companies. So the part of the book that is most relevant to that is the early section that talks about business model. And in terms of the business model, we lay out the growth factors and growth limiters that determine blitz scalability. And the key is being able to look at those growth factors and growth limiters, which are, of course, the winner take most market, generally due to network effects, the distribution or go to market strategy, the big global market, the high gross margins. And then we have the growth limiters of a lack of product market fit and a lack of operational scalability for both the organization and the infrastructure. And if you look at all those factors together, you can develop a good picture of whether or not the particular opportunity is blitz scalable. Now, the interesting thing is some of these are specific to the company, but many of them are specific to the business model or industry as a whole. It's really about the market dynamics and finding those markets which have the opportunity to build a winner take most company that is going to print money for those decades. So that's the portion that's really important to investors. Now, that's important to entrepreneurs as well. But for entrepreneurs, I think there's also these later sections that talk about the key transitions and the counterintuitive rules of blitzscaling that give them practical advice on what to do as the company is growing. So how do they overcome the obstacles that come up when you're tripling or quadrupling in size every year? What are the things to look forward to and expect so it doesn't hit you as a surprise when it finally comes around? The investors should also benefit from that, but tragically, most investors don't focus on those stages.
Well, Chris and
So
Scott, so, Scott, you mentioned that as soon as you saw this, you thought this really clearly encapsulates a lot of the things that I've seen work over my 20-year career. And Chris just articulated the growth factors and the growth limiters that are looked at. Could you guys talk about an example or two where taking those examples and looking at a company might have allowed you to either predict its successful blitzscaling or its inability to blitzscale, or it was not recommendable that that company blitzscale?
Well, it's important first to say that there are great companies that don't blitzscale and ought not blitzscale and never did blitzscale and shouldn't have blitzscaled, and they were smart not to, right? Blitzscaling is one strategy that makes sense for companies in a specific situation, which is the winner takes most, so you better damn well be the winner, right? And that's not every situation. As a matter of fact, when we look at these situations at Blitzscaling Ventures, we look at about 100 deals a month that are done by the premier VCs, primarily in the US. And when we look at those 100 deals, about 20 of them might have a business model that could make it so they should blitzscale. And then really we narrow it down to like 2 or 3 a month that we think ought to blitzscale, that really have those pieces in place. And so, you start with the universe of deals, then you narrow it down to the ones that just the premier VCs are doing. And then you narrow it even further so that it's really about 2 or 3% of those deals that those top VCs are doing ought to blitzscale. So we're talking about a sort of a narrow slice of the deals in the world. And I think we should get Chris to talk about Snowflake. Here's a company worth $58 billion last time I checked. Maybe, oh no, it was 82 billion. I don't know. So lots of billions of dollars on its way to 100. And Chris, that must be a blitzscaler, right? It had to be.
Well, that's the fascinating thing, right? Here you have Snowflake. And of course, we would love to claim it's a blitzscaling company because its success is demonstration of the power of the ideas, but it isn't. Snowflake is a classic enterprise software play. It was co-founded and incubated by my friend Mike Spicer over at Sutter Hill, who has made quite a pretty penny off of it. I don't mind saying. Hearty congratulations are in order for being farsighted enough to see this. But this is a classic enterprise software play where it is not necessarily a winner take most market. Now, Snowflake has taken most of the market, but that is because they have executed brilliantly and grown it over time. And they have not prioritized speed over efficiency. They've prioritized building the business brick by brick the traditional way. And the good news is when you pick the right market and you have the right tailwinds behind you, that can still make you an enormously valuable company, as we've seen with Snowflake. But Snowflake is not a blitzscaling company. And I've actually had discussions with some of the investors in Snowflake, and they're like, yeah, no, you're right, it's not, but we're still very happy with it.
Yeah, so it scaled enormously quickly, but it didn't have to. So that's the nuance, right? They didn't have to. It's just their product market fit was so superior that they could just pour money on that, sell it like crazy, and take most of the market because of the beautiful product market fit. It's just a thing of beauty what they have, right? But it's not that they had to be the winner in order to get the value that's available, the economic rent that's available. Okay, so another IPO that dropped recently, just an S1 so far, is Airbnb. You talk a lot about Airbnb, and I think it's pretty well known that we do think that's a blitzscaler. So help us understand why, and then it might be useful to compare it to, some other companies that we do this. Maybe you've done this already for this audience, but it's a nuanced thing why Airbnb is a blitzscaler and some other sort of market-based deals, sort of product, they're not blitzscalers. So there's your question.
Yeah, so the Airbnb is absolutely a classic example of blitzscaling. There's a reason why we use it as the opening story in the book, where we talk about the situation Brian Chesky, its founder and CEO, was facing when they were suddenly squaring off against a competitor, Vimdu, in Europe from the Rocket Internet brothers. But the thing about Airbnb, and the reason why it is a blitzscaler, is because it truly is a winner-take-most market. And that boils down to the marketplace dynamics. You referenced in your question, Scott, there are a couple of companies that are sort of welded together in people's minds. So there's Airbnb, there's Uber, and then perhaps a little further down the list, there's companies like Bird and Lime. And all of them share some superficial characteristics that appear similar, which is there is an asset in question that is typically underutilized, whether it is a house or an apartment or a car, or in the case of Bird or Lime, a scooter of some kind. And the idea is the sharing economy, the on-demand economy, is going to allow greater utilization and create economic value as a result. So all 3 or 4 of those companies get lumped together as having the same business model. But the interesting thing is the nature of the transactions in that marketplace are very, very different. So Airbnb is a classic two-sided marketplace business. You have what they call guests and what they call hosts. So they're the people who are paying for a place to stay and the people who are hosting people and taking the money. And that two-sided marketplace typically produces strong network effects, because if you think about it, as a guest, you want to go where the hosts are, and as a host, you're going to want to go where the guests are. This is the same thing that's kept Craigslist so powerful and profitable after all these years, as it keeps eBay on top, despite the fact that it has done almost zero innovation during that time. The marketplace dynamics are just incredibly powerful. But the marketplace dynamics are not created equal depending on the nature of the transaction. And what I believe is that the key things you're looking for a winner take most marketplace dynamic are a valuable transaction, a high consideration transaction, and a highly differentiated set of potential transactions. And here's what I mean. If you think about Airbnb, it is clearly one of the more valuable transactions you can have on the consumer level. An Airbnb stay is typically going to be hundreds of dollars, which is a fairly big ticket item in the consumer world. It is a high consideration transaction, and that's partially due to the fact that there's a lot of differentiation. So if you've ever stayed at an Airbnb, you know that you don't type in your city and then just pick the first thing that comes up at the lowest price. Typically, you go in and you look at the different listings, and you take a look at the photographs and see if it fits with your style and see if you're going to feel comfortable there, and look with the amenities and maybe read some of the reviews of what people have said about the previous host because you're living in their house or their apartment or what have you. And all of these things mean that it's a high consideration transaction. And that also means that you really are looking through a lot of variability. Not all Airbnb listings are created equal. And so there's a strong benefit from the guest side to going to a platform that has the most hosts because it offers the most selection of a highly differentiated product. And because it's a large transaction, you can afford to spend the time to really pick through it and choose the one that perfectly fits. Now that creates a very strong marketplace dynamic. And then of course, the hosts are going to go to wherever the guests are because they're looking to make money. Now, contrast this with Uber. With Uber, the size of the transaction is an order of magnitude smaller. Most Uber rides are measured in the tens of dollars. And it's a low consideration transaction. When you summon an Uber, you don't look carefully at the driver's profile and cross out 3 people before you select one. You just sends whoever's closest. And you don't care because the product is not differentiated. What you're buying is the ability to move from point A to point B. And typically it doesn't matter whether the car is nice or not nice, and whether the driver is a sparkling conversationalist or not. You're just looking to get from point A to point B. Those other things are nice, but not necessary. Versus, hey, this is a place that I'm going to be unconscious and lying down, open to the world for murderers to come in. And so you want to be really careful about it. You don't want bed bugs, you don't want rats, you don't want murderers. So it's much higher risk, and so it's much higher consideration and much higher differentiation. So Uber absolutely has a network effect. It's hard work to recruit all the drivers to come in and drive for Uber, and that's why they still have a strong market position in most of their markets. It's typically a duopoly in the United States with Uber and Lyft, and then overseas with other companies like a Didi, for example. But it is, while there is a network effect that keeps a lot of players out, there still is room for a duopoly, which means a lot of the profits get competed away. So Airbnb doesn't face a lot of price competition, whereas Uber does. It's locked in a titanic battle in almost every one of its markets. Now, Uber is still an enormously valuable company because it's a big market and it does have some protection from competition because of its network effect. It's just not as protected as Airbnb. So I believe that over time.
Spot. Is Uber a blitzscaler?
Yes.
Yes.
Uber is a blitzscaler because there is enough value there. And there are, again, being a blitzscaler is a continuum. We have a blitzscaling score that goes from 0 to 100. And a blitzscaler that scores 95 is more of a blitzscaler than a company that scores an 80. No question about that. But you get above a certain level and it's valuable enough to justify the risk, because at the end of the day, again, it's great if you build $1 trillion company, but as a founder, if you build a $2 billion company, that's still a pretty good outcome. So even though there is a real range, a real continuum from a binary change my life and have an impact on the world perspective, it's okay to blitzscale something that is not perfectly blitzscalable as long as it meets our minimum threshold. So just to finish off the story, I know you're about to remind me of that. To finish off the story, that's why Bird and Lime are far worse investments than Uber, and it's much, much worse than Airbnb. I predict that in 5 years, Airbnb will be the most valuable of them, even though right now Uber's market cap is higher than what Airbnb is probably going to IPO at. I would bet a lot of money that Airbnb is going to end up with a bigger, more lasting company than Uber. But they're both going to do a lot better than Bird and Lime. And the reason that Bird and Lime are even further down the ladder from Airbnb and Uber. So if you think about Uber, where you have a transaction size that's measured in tens of dollars, with Bird and Lime, now you're talking about a transaction size that's measured in single-digit dollars. And there really is no consideration. You just see where the closest scooter is or the closest bike is, and they're all identical, right? That's part of the pitch of the service. It's not like, oh yeah, these are bikes from a variety of bike owners, and maybe you want a 10-speed, and maybe you want a fixed bike, and you look at the reviews of the bikes. No, it's just a bike. And that was the thing that attracted people to the business. They looked at it, they saw that it was superficially similar to Uber, and they said, this is great. We can take advantage of this mobility market. We can come in, we can achieve a network effect, because there is a network effect. You need to get to a certain level of critical mass in order for there to be enough bikes or scooters on the street in order to be a valuable service. And then what they did is they said, okay, this is easy, because unlike Uber, we don't have to go through all this painful, difficult work of recruiting drivers. Instead, we can just put an order into some outfit in China, buy 1,000 of these bikes and throw them on the streets. Well, the problem is that anyone could do that, right? And because there is so little differentiation in the marketplace dynamics, there is not even the oligopoly situation. Instead, in most cities where they have these bike and scooter rentals, there's a raft of competing companies, and they all have their bikes and scooters littered on the streets. and there's no winner take most player. And even if there is a larger player, because again, Bird and Lime tend to be bigger than the other ones, they're still not going to be able to make any money. There's just too much competition.
Right, and they still have to spend all that money to acquire each user, and then each transaction's tiny. So it's talk about Reid's first reaction when he heard about Airbnb.
So this is a fascinating question. By the way, I'm just going to, for amusement purposes, mention that, Scott, when we first looked at Uber and Lime, you were telling me, no, these are fantastic. They're growing so fast. Everyone's rushing into them. We should look at them. And this is one of the ones I'm going to hold overview for years and years.
No, that's right. Well, I'm coming up to speed. I'm getting there.
Yep,
You're the
yep,
master.
yep.
You are
So
my sensei.
anyways, so let's talk about Reid's reaction to Airbnb. And this is a fascinating one. So, and we actually are going to have an essay and podcast about this out that's going to coincide with the Airbnb IPO. So Reid is the Series A lead investor in Airbnb, but he actually missed out on a chance to invest in them earlier in their seed round. And here's what happened. So as you know, in the investing business, the key is to get introductions to the investors. Everyone operates on introduction and referral. And so the person that referred Airbnb to Reid was an investor who was not, in Reid's opinion, a great consumer internet investor, but an investor who'd been around for a long time. You and I both know him, but we're not going to mention his name because he would feel bad about it. And he described Airbnb to Reid as, hey, this is like couch surfing. And Reid was like, couch surfing? And he's like, okay, I don't feel like this is a big opportunity. I mean, couch surfing is a pretty crappy product. It's like one step up from saying, here's a tent in the backyard, go wild. And so he just saw it as not a big enough opportunity. He's like, okay, yeah, kind of interesting, but these guys don't seem to have their heads screwed on straight. And so he passed. And people occasionally come to.
But the thing he said that I keep remembering is, okay, we're going to spend all this money acquiring all these customers and spend all this money acquiring every single couch on the globe. Is that a business that I think is going to have value? No, was the answer. It just wasn't a business it was going to cost a fortune to build it, and then it just wasn't going to be worth very much. And so why would anybody make that investment? He immediately goes to, what's the argument for scale here? And if there's a good argument for scale, then I'll pay attention. And there just wasn't.
And if there's anything I've learned from Reid over the years that I've known him, it's the ability and power to think big. And Reid is absolutely somebody who thinks big all the time, is always looking towards the end. And it's very easy for many of us to get focused on the short term. Reid's always thinking about the end game. And so with Airbnb, when he looked at the end game. I want to stop you
there for 1 second. Like, we have investors on this call. Hey, if you one of the important things to take away from this is, don't get fooled by traction. First, start with, okay, at scale, is this going to be an important company? Start with that. And if they've had some early traction, that's great, but make sure that the end game is worth it, because it's just as risky to build a company that's going to be worth this much as one that's going to be Facebook. So, sorry, keep going.
So what happened from there was this. People kept coming to Reid and saying, we think this is interesting. We think you should take a look. Because I already took a look. And finally, somebody he really respected said, no, Reid, you really should take a look at it. And he said, well, wait a minute. This is just a couch surfing deal, right? He's like, and the investor said, no, what gave you that impression? He's like, well, when so-and-so described it to me, he said that it was couch surfing. And this person said, well, he described it wrong. Here's what it actually is. And Reid's like, well, that's actually very different. And what he did from there is he reached out and did some reference checking on the founders of Airbnb. He wanted to see, okay, there may be something interesting here. Let me understand who it is that is involved. And he found out that they were design students, but he got really strong reference checks back. People are saying, no, they're really focused on learning, and they're really flexible, and they're really scrappy, and they're really doing a lot of great stuff. And so he said, okay. And then he agreed to meet with them. And he actually met with them in Greylock's offices on Sand Hill Road on a Sunday. So asked them to come in on a Sunday, sat down with them, and 2 minutes into the pitch, he said, okay, I can tell you guys know what you're doing. I'm going to make you an offer to invest. The rest of this meeting is a working session. And what got his attention was, when they came in, they didn't pitch that this was couch surfing. They pitched that this is essentially eBay for all space. And that you don't think about it in terms of airbeds. You don't think about it in terms of anything. You think about it in terms of the vast array of space that goes unutilized? And can we create an experience where people are going to have the trust, where they're willing to rent that space out, where they're willing to rent the space from someone else? And if you really realize that vision, how big could it be? And the answer is absolutely enormous. And he actually then took it immediately to Greylock's partner meeting the very next day, where it got a mixed reaction, which, as Reid will tell you, is actually the best sign for an investment. So when a deal comes to the partner meeting, everyone loves it and says, let's just do it. It usually means that it's obvious. And so there's going to be tons of competitors pounding down the door, lots of people funding things in the space, difficult to make that winner take most thing actually work. In contrast, when there's a lot of controversy, when people are like, well, I don't know, I think this, smart people on both sides, that's actually a sign that, hey, maybe this is contrarian enough, just contrarian enough to be able to grow unmolested by competition until the critical time. And with Airbnb, it was a debate and a discussion, and this is a story we've told publicly, so don't mind saying it. It famously, Reid's partner, David Z, who is a great guy, also a friend of mine, a brilliant investor who led the rounds in LinkedIn, led the rounds in Facebook, one of the most successful consumer internet investors of all time. And they had the long debate, and finally he told Reid, okay, Reid, you really want to do this deal, that's fine. Every venture capitalist needs to do an early deal that they can fail on and learn from, and Airbnb can be yours.
That's
And
failing and
so,
learning for you.
exactly. Well, it's great. Reid did learn from it, right? He learned about how to avoid the situation where he missed it the first time. But fortunately, while it cost him some money, Greylock's still going to make over $1 billion from its investment. So all's well that ends well.
$1 billion is just fine. So let's bring it more temporal. So, that's a company that's founded a long time ago. We're looking at some interesting deals right now, and we haven't planned this, but is there one that we're looking at now that you think we ought to highlight that's sort of interesting, that is, let's just sort of bring it to the present?
Well, I think we can talk about some of the deals we're looking at. Now, mind you, we are not going to share any of the confidential information that we have from the CEOs. Obviously, that's not something we're at liberty to talk about. And they've entrusted us with data, and we're going to maintain that trust because that's who we are and that's what we have to do. But I don't mind saying that there's some companies that we're looking at that are really, really interesting. And they run the gamut from consumer to enterprise because you can blitzscale in many different industries. So I'll give you a quick overview of just a couple of them. One of the companies we're looking at is a company called Bunch that's in the video gaming space. And what they do is they add video chat to social games on mobile. And it's similar in some ways to a very successful company, also a Greylock investment, called Discord, where you have been able to add chat and other communities to video games. And Discord is the dominant player in these serious hardcore gamers communities. And what Bunch said is, well, Discord is great and it has all this incredible power for those who are willing to set up a Discord server and moderate it. It's kind of a big investment, but that doesn't make as much sense for casual gamers, and casual gamers represent the bulk of the market. And so can we do something that's going to help casual gamers? And so what they created was a very easy way for casual gamers who are playing games on their mobile phones to video chat with the little heads of their friends as this was going on. And also make it very easy for video game makers to build Bunch voice chat and video chat into their games itself, so they can just launch it from within the game. And this is really appealing for a variety of reasons. Think about the network effects involved, where you have the standard platform for this kind of video chat, where it's easy to add in as an SDK, where there's a lot of virality because the individual users are going to get their friends on to sign on board. So all these things make it really interesting. And then, of course, because it is a pure software business, it has great gross margins, it has extreme scalability. There's a lot of great options because it's not strangers interacting, but friends playing together. You don't have to worry as much about things like moderation and stuff like that. So there's just a lot of stuff that makes it a fascinating company. We've enjoyed getting to know the CEO and looking at the business.
So is there another one you wanted to talk about, or
Yeah, I just wanted to pause in case people wanted to catch their breath. The other one that I will mention is interesting enterprise play that's called Crossbeam. And Crossbeam is a company that makes it easy for sales and business development teams to come together and to work with each other on cross-selling, as the name would indicate. And cross-selling is something that's becoming more and more important. There's a lot of partnership organizations out there, but the challenge is, how do we actually make sure that we are cross-selling to the right people? We want to make sure we understand where they overlap, where the relationships are. That's where Crossbeam comes in. They're the trusted escrow provider. You can connect up your CRM, like a Salesforce.com, for example, to Crossbeam, and your partner connects up their CRM system, and Crossbeam is able to then do the magic to figure out where the overlaps are and tell you who you should be cross-selling to. Now, there's a lot of great network effects here, because the more people you add to this overall Crossbeam network, the more you're able to now begin highlighting not just the partnerships where people bring folks in, but now potential partnerships. If you're a Crossbeam customer, Crossbeam could tell you, hey, here are a couple of other organizations you may want to reach out to, and they can actually begin to broker these kinds of relationships, which is really powerful and interesting. And the other element of it that is really interesting is, if you think about it, they've done a lot of brilliant stuff on the pricing side. So they've made it a freemium product, so anyone can connect up Crossbeam for free. And they also make it easy, if you decide to buy their commercial license, to pay a discounted rate to bring on your partners. So there's a lot of things they've done to very cleverly juice the distribution. It's all publicly available. You can find it on their website. They've done even smarter things that we can't talk about publicly, but it's another company we're really excited about.
Right. So earlier we mentioned scoring, sort of brushed over it. And I think it might be worth spending a little time on how we score things, because there are 7 factors, but they're not all created equal. And we divide them into 2, sort of the hygiene factors and the essential factors. And I just think it's worth going over that, because that's something that's evolved over time. And the way it evolved, frankly, is that we wanted to be able to score these deals on a 100-point scale. So we started out just sort of, assigning everything equal weight and scoring it on sort of a 1 to what would it be, 14 or something. And anyway, so we kind of ended up with some companies that got really high scores that we knew shouldn't be blitzscaling. And so we revised the algorithm, and we did about 10 iterations on it until we finally got to one where, when we scored it, it matched with what Chris knew was right. And so it's it's not complex, but it's highly evolved, and it's highly tuned, and it works. So I think it's worth talking about that.
Absolutely. So the scoring system we use originates in the book. So in the book, we talk about 4 growth factors and 2 growth limiters. The growth factors being the network effects, distribution, the market size, and the gross margin. And then on the limiter side, it's the lack of product market fit and the lack of operational scalability, basically being able to grow the size of your team and being able to grow out the infrastructure of your company and its operations. And so these were 6 things. We didn't assign any particular order to them or value to them. It was just 6 things that were put out there as growth factors and growth limiters. And as Scott described, when we first set out to use them, we just gave them an equal weight, sort of the simplest possible way of doing it. And the results weren't coming in and in line with the companies that we really felt like were going to be the most blitzscalable. And so over time, what we realized is that they are not equal weight. And in fact, there's 2 that are more important than any of the other ones, and for the following reason. So if you think through it, and in our revised version, we don't talk specifically about network effects. We talk instead about winner take most market, and we break up operational scalability into organizational scalability and operational scalability. But if we think about it, there are 5 of these that really need to apply to any business at scale if it's going to be successful. And these are things like having a big market, having high gross margins, having product market fit, being able to scale up the operations, being able to scale up the people side, right? You cannot build a company, a Snowflake, for example, without having those things in place. Because if you don't have those things in place, if one of them is missing, then the company just isn't going to succeed. You're going to tap out because the market is too small. You're not going to make enough money because the gross margins are terrible. You're not going to have sustained success because you don't have product market fit, and all your customers are going to leave you because they don't get value out of it. And you're going to break down because you're trying to scale up the people side or the technology infrastructure, and you just can't do it. So those things are what we call the hygiene factors. They need to be there. They are necessary but insufficient. And then the two essential factors are the ones that set the blitzscaling companies apart. That's winner take most, which usually derives from network effects, but can also come from a land grab, where if you acquire customers or users, you hold on to them forever, and the distribution. Because if the key is to get to critical scale, then distribution is what determines how long it takes and how much it's going to cost. And after all those iterations of the scoring system, what we ended up doing is we ended up coming with a system where we take these 7 different elements, we assign a 1 to 10 value to them, and then we feed them through an algorithm that includes an exponential factor. That means that if you're great at something, you get more points than if you're just very good. In fact, it's much better to move from good to great than to move from bad to good. And then the fact is they're also weighted. So the winner take most and the distribution are weighted to represent nearly 60% of the total score. So those are much, much more important than the other ones. And you basically cannot blitzscale unless you have them. But if you have them, then it's really critical to see how you do on the other hygiene factors, because that helps determine how easily you're going to be able to blitzscale. For us, a score of 80 or above is what we consider blitzscalable. It's not something that a lot of people get. As Scott mentioned, when we filter it down, it's something like 2 to 3% of the deals that are being done by the most valuable, most respected, big name venture capitalists in the world. But for those companies, we think that there is a strong possibility that those companies are going to do very, very well and end up really dominating the marketplace. So within that, again, as I mentioned, they may score 80, they may score 99. We've never seen 100. It's hard to get 100 out of 100.
Snap was close.
Snap, exactly. Snap was close. A new social network that finds a way to grow around Facebook is something that is enormously valuable. Slack was also very close. There's a bunch of these that are really, really good. But the fact is, as long as you get above 80, the possibility of blitzscaling, the benefits of the feedback loop from the network effects and the winner take most market are such that you can make a colossal amount of money and have a huge impact on the universe.
And I want to go back to the original point, one of the original points we made, which is that not every good company should blitzscale, right? So if you don't get an 80, it doesn't mean you should invest in that company. You need to look at those hygiene factors. If you score very well in all those hygiene factors as a company, then boy, that could be a really good investment too. You just want to make sure you've got a great team and a competitive dynamic and sort of a market dynamic that's going to enable a successful business and a successful upstart to take a lot of share and grow big. But there's something protecting you from your competition, be it your product's great or there's lock-in somehow with the customer that you can make happen, or you can maybe lock up some channels. So you don't have to score above 80 to be a good investment. And you can actually use the teachings of the book to make yourself a better investor in companies that shouldn't blitzscale, just because it does lay out the things that matter for a company. And if you really tick all those boxes, then there you go. So let's think of a great company that's just gets a terrible score, and I'm going to throw out let's name a law firm. Let's name Cooley, which is a law firm I love to work with. How's that for blitzscaling?
Well, if you think about the blitzscalability of a law firm, it runs into severe problems. So first of all, is it a winner take most market? Well, by definition, it isn't, because we can often look at Cooley, Godward, and then we look over here, here's Fenwick and West, and we look over here, here's DLA Piper. There are all these firms that are roughly equivalent in terms of reputation. Cooley may be the first among equals, and that's one of the reasons why we use them as our lawyer, but it's not something like where if Cooley said, oh, we can't work with you because of conflict, that we'd be torn up about it and weeping. We'd be like, okay, well, I guess we'll work Wilson Sonsini instead. So there's no winner take most element. And then from the distribution strategy standpoint, it's like, okay, is there some sort of virality? Is there some sort of network that we could tap into? I mean, this is a really heavily trodden area. These law firms are all out there doing their best to partner with these accelerators and other folks like that. It's really tough to get a differentiated go-to-market strategy. So again, great business, and the partners make a lot of money and they serve an important piece of society, but it's not necessarily blitzscalable.
Right.
Now, Jeff, I noticed that we're getting towards the top of the hour. Are there any questions that we have failed to answer we should really get to before we open it up to Q&A? Because I did see at least one Q&A thing come in. I haven't had a chance to look at it yet, but we want to make sure that people have a chance to ask their questions.
So one question that came in from the audience was, do you guys only invest in companies that are capable of blitzscaling?
Well, that answer is fairly straightforward. Yes. For Blitzscaling Ventures, we only invest in the blitzscaling companies. We are looking at that 2 to 3% of the deals done by top VCs, and those are the only ones we'll invest in. Again, the way to think about it is in a given year is we'll look at 1,000 deals, all of which have been done by a top tier VC. So these are all the deals that everyone wants to get into. We cut it down to 20 or 30. So 2 to 3% of them are the ones we consider most blitz scalable. And then we'll further cut those down by working with the CEOs, understanding the businesses, and ultimately choose just 4 or 5 to invest in over the course of a year. So if you are a company and you want to get invested in by Blitzscaling Ventures, it's kind of tough because we're going to invest in roughly 0.5% of the deals that have been done by the best venture capitalists in the world. So you have to start by getting invested in by the Greylocks of the world, and then you've got a 0.5% chance of getting our investment. But if you do, it is a huge sign that we believe your company has what it takes to be one of these 10 billion, 100 billion, $1 trillion outcomes.
And Chris,
That
I'd
said,
like to follow up there. I'll come back to you, Scott, so one of the things that we're doing in Global Scaling Academy, which is similar to the way we look at things, and really identical to the way that we're looking at things in Blitzscaling Ventures, is working with entrepreneurs or working with investors who have portfolio companies or corporate innovators who have ventures that they want to scale. And we're taking some of these same ways of looking at things, the Blitzscaling framework, and we've turned that into a Blitzscaling canvas and a scoring model that we use to work with each of those ventures at the venture level to help them assess, where are you today? And we would come up with the same score. We're going to look at them the same way that Blitzscaling Ventures would look at a company. But the difference is in Global Scaling Academy, we're going to try to help them see what are some of the things that they could do to get further down that scalability path. Chris, could you talk a little bit about, as the originator of the framework, how those tools can be used, not just to look at that 0.5% that has received an investment from a top tier VC firm, but how it can be applied to literally anyone's company in any of those situations to help them scale better?
Absolutely.
And this happens to be an answer to Balaji's question that he just asked.
Exactly. And Balaji, thank you for coming on. It's great. And so Balaji was just saying that he wanted to ask this question. So he's recently recovered from COVID-19. So thank goodness that you've recovered. We're very glad to hear that you're doing well. Balaji is one of the entrepreneurs who's been through some of our Global Scaling Academy programs in the past. We're very glad to have him here. So the question is, well, what do you do about this? How are you able to apply these tools, and where can we access these tools? So from an application perspective, it's pretty straightforward. Blitz scalability is an overall great sign for your business. And you can look at it, even if you don't believe you have a blitzscaling opportunity, you can still grade yourself on the basis of the 5 essential factors. So the 5 essential factors that are not the 2 main ones. So again, market size, gross margins, product market fit, and the ability to scale. And those are still going to help you build a great business. As I mentioned, those 5 things are a prerequisite for any great business. And then once you've built a great business on that basis, you can see, can I drive enough in the winner take most market, or can I drive enough in the distribution side by creating network effects and creating virality to ultimately make this a blitz scalable company? Because again, if you build a blitz scalable company, then you have the opportunity to really generate a remarkable return. And it's not easy to do. And even if you don't, you can still apply those other factors to build a great business. Now, the interesting thing is that we have actually built these tools. So Jeff, I don't know if you want to take them through the tools. You've been putting them out in the chat room, but the people who are watching the recording won't see the chat. So maybe you can take people through those tools. And you'll need to unmute.
Yeah. Well,
I am on mute. I have a crying baby and a barking dog all at the same time in this COVID household. Welcome to 2020. So I've just placed into the chat 2 tools that anyone on this call, or indeed anyone you know, feel free to share these.
So Jeff, quick note, your tools were sent to panelists, but not to attendees.
Oh my gosh.
So that's why I wanted to make sure that we got this out to them.
That was my mistake again. Okay, so the first tool is an online grader tool. You can find it at blitzscalabilitygrader.com. And it is a simple online questionnaire developed by Scott and Chris and I based on the framework. that allows you to answer a series of questions and rate yourself on each of the growth factors and get an online score. That score gets submitted to us. And if you're a member of the Global Scaling Academy community, you get to review those scores with us and get directional guidance. We also have created the Blitzscaling Canvas, and you can find that at globalscalingacademy.com/canvas, where it's available as a free download. I'll put that into the chat as well. But I also want to take a moment to pull it up on the screen so that you can get a quick look of what we're looking at and kind of see how this works. This is a tool we designed so that you can take it and work with your teams. So let me just share my screen very quickly, and I'll show you what it looks like. So this is based on, I mean, we've all seen plenty of canvases, right? There's the famous business model canvas. And one of the things that we all realized as people that have worked all over the world with corporate teams and founder teams is there really weren't, as Chris noted, he and Reid concluded in 2015, there just weren't any books about scaling. And we didn't find any tools for working on scaling either. And so we've turned blitzscaling into a series of tools that you can use. And Chris, maybe you'd like to share real quick. So the story about this, just how Scott described seeing Chris present and immediately having an epiphany about how we could form a fund out of this. My epiphany was the first time I read the book, I said, this is a framework and this should be turned into something that people everywhere can use in their own teams. And so I did the first version of this on a plane from Venice, Italy to Qatar, and Chris created the second version in about 30 minutes after that, and we proudly displayed it last year in Doha, Qatar. This is the first time that we're showing it at a live online session. It's literally been available for a week, so get your copy and begin using it. Chris, would you like to?
Well, I was going to say, I will happily talk a little bit about it. Again, we are short on time, so I won't talk for too long. But essentially what this does is it gives you an easily used version of the Blitz Scalability Grader. And this is especially helpful, for example, if you're doing a workshop like we sometimes do, where it's difficult to get everyone onto the internet to fill something out. Of course, we want them to do that eventually because that'll give them a great sort of very neat electronic report. But this allows you to just very physically, if you just have these papers in the room, get a real visceral sense of how blitzscalable something is. So what you do is you go through and you rate yourself on a 1 to 5 scale. 1 to 10 was too difficult to instantiate, so we did 1 to 5. It's a little less granular than the full-on grading scale. And based on the number, you can then color in the section for network effects or distribution or what have you. And so once you've colored everything in, the total area that's covered up out of that 10 by 10 square, which of course represents the 100 points, gives you a sense of how blitzscalable you are. And then the holes in that you can look at and say, well, what are the areas where we really need to improve? And how can we now figure out, by going into Global Scaling Academy, for example, and looking through some of the courses on those specific areas, how we can improve that area for our company.
And one example I want to bring out is Tesla. So there's a question in here, is Tesla a blitzscaler? And the answer is no. It's a manufacturing company that manufactures cars. There's no network effect. But is there, right? So they have these charging stations that they've put all over the country. So they took a humdrum manufacturing business to this consumer durable goods manufacturing business and put in a layer of network effect that has turned out to be an enormous market differentiator for them. And so while no, Tesla's not really a blitzscaler, because charging is a big deal and quick charging is really expensive to install on your own, and they have put this network of charging stations in place. And so you can actually feel comfortable buying a Tesla and driving across the country because of these stations. It's when I talk to people about which car they're going to buy that's electric, the Tesla wins because of that feature quite a lot. So that's I just wanted to get to that question before we moved on. And one more other thing, Chris talked earlier about, do we only invest in blitzscalers? And the answer is yes, but there is a side door, which is that if you have a company that's starting to scale up really quickly and it has a high blitzscaling score, we can bring it to some of our top tier VC friends and invest together in an A round. That's very much the exception to what we do. And it may never happen, but it may happen once or twice. Anyway, so that is a side door that I wanted to make sure we mentioned before the session ended.
Yep, and I love the engagement that's going on in the chat and the Q&A and so many old familiar names. It's been fantastic. I just want to comment briefly on Tesla and what they did with their supercharger network, because what's interesting there is it's very much like something that Amazon did. So you take something which is an operational issue and you turn it into something that then becomes a strength of the company. So in the case of Tesla, the funny thing is Tesla's are incompatible. So their charger is literally incompatible with the chargers that are used on every other electric car. You need to have this special adapter to be able to use a non-Tesla charger with a Tesla, and then you cannot use a Tesla charger with any other car. But
One of the
what
ways
seems
that
like
that
craziness
adds
is
additional,
actually a network effect.
but it also creates exclusivity, and it underlines the fact that they won the land grab. I was at a hotel 3 months ago in Denmark driving an electric car that I had rented. And when I arrived at the hotel, there were two specially branded plugs for Tesla that were close to the hotel, and I couldn't get into one of the other ones. The Teslas were sitting there empty, waiting. It's like the guy that drives his Ferrari up in front of the hotel, right? So not only did they provide the station, but they provided exclusivity with it.
Yeah, really fascinating stuff. And of course, as you guys may have seen in the news, thanks to the massive increase in Tesla's stock price, which again, great investment, even if it's not specifically a blitzscaler from the start. So Elon Musk is now the world's second richest man, just recently surpassed Bill Gates. So that is a pretty remarkable thing. And then if you look at the ranks of the world's richest people, and it's Jeff Bezos, and it's Elon Musk, and it's Bill Gates, I think you see a theme in terms of the ability of applying blitzscaling to technology businesses.
Well, and let's not forget Elon. PayPal was an original blitzscaler, and so Elon certainly understands the power of winner take most. One more question that I saw is blitzscaling relative to the market, or does the market itself have to be big? And I think I know the answer, but Chris, you should talk to that. Like, should you blitzscale into a small market?
Yes. So the key thing is with blitzscaling, you are taking on additional risk. So if you believe that the investment is justified by the size of the market, you could still deploy the blitzscaling tactics. So for example, sometimes we talk about blitzscaling companies where there are local network effects. You could theoretically blitzscale locally and achieve a local durable market leadership, even if you don't go globally. But it has to be something where you look carefully at the size of the market relative to the amount of money and resources you're willing to invest. Because at the end of the day, if you're going to take on the risk, why not take on the risk going after a gigantic global market that can change the world?
And the thing is, the world is so networked today that finding something that's truly local is not that easy. If you remember Facebook, there were plenty of campuses that already had a social network embedded and that they had scaled up, and the winner had taken that campus, right? Along comes Facebook, who surrounded them with other campuses and subsumed all of those winner take most local winners because they weren't the global winner. So there's a risk to that when your market is, you think your market's regional, but it turns out it's not.
So I think that's a great place to, as we reach the top of the hour, to thank Chris and Scott for joining us tonight. Again, this is the inaugural episode #1 of the Blitzscaling Breakout, the monthly event and podcast series at Global Scaling Academy, where we will talk about how to apply blitzscaling to venture investing with guests from around the world who will bring perspectives about investments they've made or companies that they're scaling. And we'll provide this set of frameworks to continue to provide our listeners and members insights about how to apply blitzscaling to investing. If you're interested in Global Scaling Academy, this is where we do the work with you of applying these tools to you and your business or your corporate venture or the portfolio company that you've invested in that needs additional support. Inside the community, we also run a private members-only group for accredited investors called the Blitzscaling Investor Network. And this is your opportunity to use the Blitzscalability Grader tool that we've just shared to submit deals that you'd like to discuss and get feedback from Chris and Scott every month. That's also a benefit to members inside the community. I've just placed a link in the community. If you're interested in joining, you can simply fill that out. We are running a lifetime membership special between now and December 31st. And of course, we're always available to answer questions. I'm Jeff Abbott, jeff@globalscalingacademy.com. Scott, Chris, always a pleasure. Thanks to everyone. Great to see our friends and members. And we'll see you next month at the Blitzscaling Breakout.
Thank you so much, Jeff. This has been a pleasure as always.
Thank you.